Right, the idea here is that we investigate a topic which will be helpful to traders, old and new. We've got two teams, one technical, one fundamental, that write these articles for us. They get posted on that mail group. Mark, this week's contribution comes again from Intellidex, from Stuart Theobald. It's about the whole issue of risk, once again, and it's about the idea that you need to look at your portfolios and have a look and see what kind of returns you're realizing and what kind of risk you're exposing yourself to. Because of course it's one thing to have good returns from a portfolio, but it's another thing if you look under the hood and discover that the kind of stocks you own have an enormously significant volatility. The standard deviations are all off the charts. Just from your perspective, explain to the viewers what it is this piece deals with and where it might be useful, what its applications are.
Yeah, I mean, look, the first thing to remember is that the article kind of starts off with the Sharpe ratio, which is a kind of fundamental ratio that one deals with in financial math and financial markets in general. The real useful thing is kind of, as you've alluded to, is it's the risk-adjusted return. What you're saying when you work your way through this equation is, am I getting, to what degree is the reward I may be getting facilitated by the amount of risk I'm taking?
Yeah.
If you step through the math, it all becomes fairly straightforward. You can do it on the price of the stock. You can do it on a number of different aspects of the stock. It's a useful way of comparing across various funds and various kind of asset classes. But one good way to remember it is that a Ponzi scheme, for example, will have an extremely high Sharpe ratio.
Okay.
Because if you work your way through the equation, your return from a Ponzi scheme will factor through it and manifest as a high number. We can take it further and develop it further if anybody's interested in contacting us and taking it through. But it's an very interesting concept.
So this is a chart which comes out of the thing, and it looks at the Sharpe ratios of particular stocks, which suggests that if you look at MTN at the top there, look, it's been delivering higher returns. But the Sharpe ratio being high suggests that there's a lot of share price movement over a period, if that's correct, I think. And conversely, FirstRand at the bottom there, delivering slightly lower returns, but doing so with a lot less share price volatility. I think that's what this, no? Other way around?
Other way around.
Okay, well, take us through it.
What you just don't simply divide the standard deviation by the return. You've also got to take from the return what the return would be on risk-free, risk-free cash. So the higher the standard deviation in general, the higher the volatility of the asset. So you can see, standard deviation on MTN 51, 22 on FirstRand. FirstRand has much less volatility, but is providing much less of an annual return than MTN. So there's a kind of a swings and roundabouts aspect to the Sharpe.
I noticed somewhere in the sort of literature going around that there's a bit of a move towards this idea that people are unfairly dismissive of low volatility stocks. In other words, the argument is we should be more attracted to low volatility stocks because in the long run, you often get better results out of those. The idea that you have to take on lots of risk in order to get good returns is perhaps not always borne out.
And this again, there is a time horizon aspect to it. I mean, in the long term, yes, holding a low volatility stock, you've got less disruption to your cash flow, and if the returns are steady, can be very, very good. A high volatility stock, high returns coming in, bigger losses coming through, but ultimately, are you being rewarded for that swinging around of your capital?
Yes, and by extension to that, the idea that to go really to the bottom end of the market and look for penny stocks, because on the idea that, no risk, no return, put yourself and money in harm's way. To some extent, people are attracted to those opportunities. There's a real sense that maybe they overpay for them because they're looking for the hot opportunities, and that net long run. And I think we know this from personal experience. A lot of people who are very attracted to turnaround situations, fallen angels, penny stocks that have fallen on hard times, they think that's where they're going to make the real money. But net, after a period of years, a lot of them basically just end up making nothing, whereas the boring old portfolio of quality players are the ones where people are making good gains.
There's a lot of research about this, massive amounts of research, but the key thing for the investor is what time horizon suits you. And naturally, there should be a tendency towards having a lot of capital invested over longer time periods. But there are good returns to be made in shorter term investments, but you've really got to know what you're doing.